Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets in all their forms. And it's been somewhat of a quiet week, but finally seeing some progress towards Miles' predictive pullback to a support of around 1980 that we've talked about on this show. In fact, as we record, we're at 1,994 roughly on gold, but we did see 1,985 this morning. We're down 3.6% in gold in 2024, and silver continues its decline, but stabilized. Platinum, relatively unchanged, and we'll get to palladium a little bit later. But anything to just start us off with in gold and the progress towards that support, Miles?
No, I mean, I almost gave up last week.
Right.
Which is how you know that...
yeah, it's going to come. Yeah, because it was stuck at 2020, and both Tori and I were like, well, maybe it's going to hold.
Yeah, I know.
But it didn't.
And you're always one news event away. You don't know under what timing that comes, right?
So, yeah, and then lo and behold, we wake up Tuesday, and gold broke right down through support, which was beautiful. It was a beautiful support break, really aggressive down through that rising wedge, brought us all the way down to, as of today, which is Wednesday, Valentine's Day. Happy Valentine's Day. We touched the 50% retracement line, seeing a little bit of a bounce. I don't know if this move down is quite done yet. I was mentioning to Rob before we started recording, when you look at the 4-hour charts, we're just seeing us break down into oversold territory on the relative strength index. I wouldn't be surprised if we see a couple little ball bounces down the stairs here, one or two. And we've got a really nice support line in between the 618 fib and the 50% line, and we call that the 200-day moving average, sitting at around 1965. So there's going to be the next number that I'm going to give up on 2 days before it happens. I think we'll see 1965 here. I'd love to see a RSI divergent, like 3 drives pattern into that number with a big reversal. I love when charts work out exactly the way I think they're going to in my head. They never do, but it would be nice if I get to ring the bell on this one. So I think we're almost there.
And as a note to our customers that are putting money together to make a purchase, okay, so we dropped from 1991 to 1965. That's 1.25% from where we are now. So if you have money ready to go, don't get too caught up in trying to play these numbers.
No. Yeah, you're right, because we may not even be awake for it, right? It can happen in the Asian market.
Well,
it can happen in the London market.
It happened in the Asian market, a few months ago, and it was shocking everybody.
And again, we're still one news event away. Who knows what that's going to be.
Exactly right.
Silver, Miles, just looking at that chart, was down again in January, and we're right back where we were last week, relatively unchanged this week. We're recording at 22.40 roughly, and so anything that you see changing there, I will say this, with gold's decline today, it knocked the gold to silver ratio down below 90. So we got as high as 92. Now we're 89.
Right.
So that tells you that silver has kind of hung in there during gold's decline.
Yeah. I mean, we're at 22.35 right now on silver. For people that are waiting for the big rally in silver, we're going to have a ways to go yet.
Well, we mentioned this last week in silver. Silver kind of has an internal and an external trading range that I'm seeing. It's sort of trading between like 22 and 24.50, and it's spent the majority of its time there over the last 3 years. But then it has this external range between about 20 and 26, where it's spent 80% of its time between 20 and 26, and probably 50% of its time between the smaller range, 22 and 24 and a half. And we're right down at the bottom of that 22 mark right now. Same place, like you mentioned, Tori, we were last week. So you're dead on. This was a reactive move in gold, probably because gold and silver have completely detached from each other. Gold is pushing all-time highs. It's setting new trading ranges up at the all-time highs. Silver's halfway there. So silver is going to trade completely differently. I wasn't surprised to see silver not follow gold down here over the last couple of days. I think silver is playing its own game.
Right. And, gold can certainly decline further. Like you're saying, I'm not predicting that, nor am I wishing that. But when that ratio corrects, the 50-year average is closer to 60 to 1, 40-year average more like 62 to 1. So we're about, 25 points askew. And that correction can happen in a declining market. Silver could sit right where it is, and gold come down to 1785, and that would bring us just to 80.
We're not thinking that'll happen. Yeah,
No, not at
even.
all. I'm just trying to get the listener to understand the way these ratios can move. It doesn't have to happen in a climbing market. But again, gold has been propped by things like certainly geopolitical tensions being number one, social issues, and then you also have the spending and the debt concerns. So if those things start to soften, especially in an election year, it's okay for gold to soften here a little bit and form a base. But silver, to me, showing that it's been doing that. Platinum is also relatively unchanged. I think we're 898 as we record, just under the 900 mark. Nothing exciting to report there, Miles. I mean, I know we probably sound like a broken record, and your chart looks like a sideways consolidation, but what do you see? Yeah.
Yeah, I don't know what to say, Tori. I mean, you kind of nailed it. Platinum is definitely still right in that consolidation wedge, but it's enormous. I mean, you're going back to a high at 1330 and a low at 600 back in March of 2020. Most of its time spent between, we had a couple lows down around 800, like back in August, September of a couple years ago. But the ceiling has just been compressing down and down and down. And eventually we're going to get to a breakout point here one way or the other. I think if platinum stays above the November lows and starts climbing again here, I think that would be quite bullish for platinum. But compared to gold and silver, platinum is below its 200-day moving averages, but is kind of hugging it. It's coming back to it pretty aggressively every couple of months and just trying to decide where the price wants to go. I think they're going to follow gold up. We know that there is a difference between, say, a currency hedge like gold and commercial industrial commodities like platinum, palladium, rhodium, iridium. They have different purposes in the market. So it's actually not surprising to see platinum, it's sort of like silver, just not playing catch up.
Well, and you alluded to the palladium. I see Rob just chomping at the bit here a little bit, wanting to talk about that metal too, because Rob, you've done a lot of deep digging into palladium, and we've talked a lot about it here on the show, but behind the scenes, in the office as brokers, trying to manage client portfolios, and we want to give the best advice as to when to position. At what point does palladium start becoming really attractive and not looking overvalued and looking undervalued and a good opportunity?
Hey, it's up almost 9% today. Aren't we excited about that?
Yeah.
Does anyone care?
Yeah, well, we do care.
We do.
This would actually be the third pop of a 30%. From the low, we hit 855 last week, and now it's 955. So that's a 23% increase. And this would be the third 30% pop in a major declining market, in a now technical bear market.
It is a bear market. 80% of the palladium annual consumption goes right into automobile catalytic converters. And the reason for that was, going back a decade and a half or so, the cost of platinum was 2 to 3 times greater than that of palladium. And so the automakers made the switch over to palladium, even though it took twice as much palladium to do what platinum did in these gasoline catalytic converters. It was still a huge saving to the American automakers. And then as the price of palladium went into $2,000 and even $3,000 an ounce, it topped out at around $3,400. The automakers were just stuck because they had already committed to using palladium. Then their resistance to switching back to platinum was having to jump through all the regulatory hoops that they had to make the switch to palladium the first time. BASF came out with a report early last year that said, no, you can make the transition back to platinum without having to have EPA regulations and all the involved costly research it took to get the approval back to platinum. Is saying, no, it's fine. It's not a problem. And I started telling my clients that, hey, look, they are going to start switching. And they didn't send out announcements that they were, but the results are palladium down 38% last year. So last year they were in the midst of switching back to platinum, and that trend is likely to continue. Part of the problem is twofold. One is there's a lot of palladium above ground right now that is not being used. Two, 40% of the world's palladium comes from Russia, and so the American automakers are reluctant to deal with the Russians and their supply. So the outlook for palladium is probably platinum doing nothing, palladium falling back into the $600 and $500 price range, maybe even into the high $400 price range, with platinum staying pretty much where it is and where it has been for, it seems like forever, kind of in the $850, $950 range. So my thought is to wait to switch from the platinum that we went to from palladium 2-3 years ago, and we were early, and then back to palladium when we can switch out maybe at a ratio of 1.75 ounces of palladium equaling an ounce of platinum, or 2 ounces of palladium equaling an ounce of platinum. But Miles, you have a different take on that. I think that the magic number is a 2-to-1 ratio, but your charts are saying something different. Tell us what you're looking at.
Sure. Well, I don't disagree with you that I think the magic number is around 2-to-1. I wouldn't call that the bell ringing number because that's 5-to-1, which was 2008, 2009. And I wouldn't call that something I'd be targeting either. You know, like we mentioned with gold, I'm not really concerned with another 1 or 2% drop on the front end. I'm not going to be concerned with a 1 or 2% miss in the top on the back end either, or 5 or 10% when it's all said and done. So for me, when I'm looking at it from the standpoint of the magic number, it's kind of like, okay, what's your median, what's your average? Now, platinum and palladium is a lot harder to track than, say, gold and silver, because palladium didn't even exist as a standalone metal until the 1950s, 1960s. We didn't have the technology to separate the platinum group metals amongst each other. So it doesn't surprise me that we don't have the same type of track record, and it's going to take a long time for those prices to kind of figure out what their averages are. But with the data we do have, I think you can fairly argue that around that 2-to-1 ratio is about what we've seen as an average. We've just seen it significantly higher and significantly lower. So it's much, much more volatile. So me personally, I'm probably looking for something swinging on the other side. You know, I may be holding out for like a 3-to-1. I don't know if we're going to see 5 again. I don't know if we're going to see platinum 5 times the price of palladium. I mean, palladium is 5 times more rare.
Right.
So it shouldn't swing that much.
I
But
agree with
something
you.
on the
Yeah.
other side of what I would look at a chart and say, okay, your median is probably somewhere between like 2 and 2.5.
Okay.
So something on the other side of that is where I personally would want to start stepping out. I feel the same way about silver. You know, we get to 60-to-1. That's your median. I'm probably not going to come out of my silver at 60-to-1, but I'm not waiting for 32 either, because it's not worth the risk on that side. So it's finding something in between the outliers on both sides, but it's finding something in between and then extending your range out, I don't know, halfway between the midpoint and the outlier. You know, picking something that feels reasonable to you. So that's kind of what I'm looking at here. Now, I can tell you this, I'm stacking the deck on those phone calls right now. So any of my clients listening, or any of my clients I've gotten to talk to so far, and I know I'm not the only one in the office doing it, I'm prepping people right now. Maybe for a call that we don't get to make for another 6 or 12 or 18 months.
Right.
But when 6, 12, 18 months comes around, we're not going to have a lot of time to go back through this stuff. So I know that's kind of what our focus has been.
Yeah, and I think too, I mean, we've talked as a staff about coming out of it in waves. You don't have to, you know.
All in, all out.
That's right.
Right.
So if you can do portions, maybe
Right.
you do a portion at 60, you know, talking about the gold to silver, but you wait for that more of an outlier event. Same thing here. Now, in 2001 and 2008, palladium bear market saw an 87% and 72% decline, respectively. Well, we're at 74% right now from that 3,450 high after the Russian invasion of Ukraine in palladium. So we're already at almost a 3/4 of the way down to where we started the rally. That's a lot to me. You guys are both right. I'm not looking to make a move here. As tempting as it may be to pick up 75 or 80% more ounces of palladium than we could have, that's not enough for me to even begin to look at it. And, Rob, I appreciate you bringing this all up. I don't see the low put in yet, right? We've shown no indication of any support or any stopping in the decline. And the futures market is, you told me, experiencing a net short position. Like, the big money is short.
Well, and I'll tell you something else. The spread between retail and wholesale, before we even add any of our margin to keep the lights on, is 20 to 21%.
Wow.
Difference between what it costs to buy an ounce of palladium on the market versus what you get when you sell an ounce of palladium. And that's before we even add our fee.
Yeah.
It's a 20 to 21% spread. So I think we have to wait, given the spreads, given the direction, given the fact that we haven't seen any indication, as you said, of a bottom being put in. And knowing the historical ratios, even though they're not as far back as gold and silver, I think there's compelling argument for at minimum 2 to 1. I think Miles has convinced me, instead of starting a little bit before that, I'm waiting for a 2 to 1 and maybe trending down the last trade, hopefully at a 3 to 1 ratio.
Yeah. And give this market time, right?
Yep.
I mean, if you're going to
Yep.
see an industrial swing in those catalysts, so if you've got an auto catalyst or catalytic converter that's transitioning from palladium to platinum or a tri-metal gasoline type structure, that's going to take time. And then you've got the market share of electric vehicles gaining ground. That's to the detriment of palladium demand.
It is very much so.
And so all of those factors, again, will take some time to play out. But
Correct.
I am not a palladium buyer here.
Good.
Anybody want to talk about the paper markets?
Yeah, I think it's worth mentioning.
Transports got whacked.
The dollar's unmoved. And then, the equities are looking dangerous to me.
Yeah.
Yeah. So here's the big thing on the equities market for me, right? If you go back to the previous highs in, say, the S&P, back to what was that? December of 2021. Then we had the big drop through 2022. We all thought the wheels were coming off. And then the equities have rebounded, the S&P, and we're up actually about 5% above that high from 2021. Well, that's your S&P. That's a pretty broad market. And this gets back, Rob, to what you and I were talking about a couple weeks ago. Compare that to, say, the Russell 2000, which is your smaller and mid-cap companies. That high peaked in October of 21, so a couple months prior to the S&P. How far above that price do you think the Russell 2000 is? If the S&P is up 5%, how much up is the Russell 2000?
No clue. I don't follow it.
It's actually down 20%.
Wow.
So as we were talking about a few weeks ago, if you want more and more examples of a small handful of very speculative stocks in very specific industries are propping the entirety of the stock market up right now, or at least what you see on TV, I think that's probably a great example right there.
Oh, it just feels like a new bubble forming to me, honestly. I mean, the FANG's up 75% in less than a year. Good job, Fed and Treasury. You're getting another bubble going here. But we did question last week whether or not we would exceed 5,000 on the S&P, and it did. It went through that, and we're sitting right at it now.
Right at it now.
And I don't know where this corrects back down to, but those Magnificent Seven stocks are now valued at 50% of GDP. That is mind-blowing to me.
It's
13 to 14 trillion, depending on the day and the value. But yet, why is Bezos selling $4 billion worth of Amazon stock in 4 trading days? Jamie Dimon of JP Morgan did that too at the end of 2023. Like, big money might know what's coming. I don't know.
Well, and you take the FANGs, what'd you say, 75% last year?
Yeah, since March.
Well, how up is the NASDAQ 100 as a whole since March of last year?
I think you have the answer, Miles.
I do. It's up about 65%. So the NASDAQ
Okay.
100 as a whole is also doing relatively strong. But that's coming off the heels of the crash that happened prior. So the NASDAQ is only up about 7% from the November 21 highs previously. So if you kind of look high to high here, sure, they look fine. But like I think you're pointing out, is we're talking about a very small number of companies with a massive amount of weight they can push around, propping those prices up. 50% of GDP is kind of terrifying. I'm not going to lie.
Yeah, it is. And this can't be sustained.
That's some robber baron numbers.
I know. I'll tell you another concerning thing here is the CPI that just came out. So you think, oh, relatively unchanged. But it was changed enough because it was changed in a way that it climbed again. So CPI came in at 3.1% year over year. 2.9 was expected. All right. The core CPI came in at 3.9 and 3.7% was expected. So inflation has started climbing again is what that means. Well, the core CPI services ex shelter, which is Powell's favorite indicator, actually spiked 0.7% this month alone. That's the biggest increase since September of 2022. And here's why I say that's important. That's important for the equities markets that we're talking about because that signals another headwind for being able to cut rates. If inflation starts to climb again and you cut rates, now you're really pouring gasoline back on that inflation fire. And you think, well, okay, there might be some room. It's a political year, you guys. It's an election year. And they're going to have a lot of pressure on not cutting rates, in my opinion, rather than just leaving them alone. But the market has priced these rate cuts in.
Sure has.
So that's going to be an impetus for the decline. You know, and here's the president 2 days ago saying the stock market going strong is a sign of confidence in America's economy. Well, we know that that part is true, that people do believe the economy is doing well. So what do they believe when it's not doing well? When those equities turn down again in an election year, this is kind of really hard to predict which way this goes. But I don't think that there's going to be a sustained rally. They could pause here and kind of move flat, or I think there's more likely a significant decline because, 48% of Americans don't trust the numbers anyway. Mm-hmm. And please understand that prices are still climbing. We're not in deflation. Prices aren't shrinking. Inflation is still intact, and in fact, it has picked up some steam. So that should concern every American, every listener to this program, that life is continuing to get more expensive. And they adjusted October and November up.
Of course they did.
Of course they did. And the media didn't even cover it.
No, they didn't.
So it wasn't even as good as they were making it out to be. So, yeah, to me, it's worse than expected. And Miles, I'm going to call for a little bit of a market correction here, that we may have seen the top here.
Oh, I love the pessimism. It makes me so happy, Tori. So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, head on over to our website. You can find more information at McIlvaney.com. We're also on Twitter at ICA Gold and Facebook at McIlvaney Financial. And as always, you can give one of us a buzz here at McIlvaney Precious Metals to discuss your personal portfolio at 1-800-525-9556. Thanks for listening and have a great week.